I'm Joanna Simpson here at Risk Minds International in London. Joining me now is David Cassonnet, Global Head of Business Development at ActiveViam. Thank you very much for joining me today.
Thank you for inviting me.
And just tell me, what are the key considerations for banks deciding between the IMA or the regulator set SA for calculating market risk capital requirements? And what are the trade-offs involved in these decisions?
Well, usually the main concern is it's a question of optimization at the beginning. So it's all about by using the standard approach methods or the internal methods for particular desks, because a desk is very specifically defined according to the regulation. So in the FRTB world, it's very important, and each desk needs to be classified accordingly. So the real trade-off here is how much would I save in capital if I use the IMA versus SA for a particular desk. Now, that's the first, I would say, criteria. The problem is that in addition to doing standard approach, because that's mandatory, so you have to do it, choosing the IMA has a real impact in terms of cost, because cost of operating IMA is not neglectable. This is something that could have a huge impact on operating. That model comes with a lot of constraints in terms of governance, in terms of monitoring, and if you're not right, then you get penalized. So if you do all of that for a small saving on capital, and at the end you get you penalize because you get a surcharge of capital charge, then it's a problem. So I would say this is really the balance between how much you save depending on the methods and how much it costs operating it.
And just tell me, what pressures is FRTB placing on banks' data infrastructure and systems, and how are vendors helping banks navigate the remaining implementation challenges?
There's a huge data impact. There's a few reasons for that. First of all, the data that are used for calculating the FRTB capital charge are different than the one used for Basel II. So you can't really reuse what you got before. You have to store another data set, other type of P&L vectors, other type of sensitivities, and you need to store that for as long as you do the calculation. So that's mandatory. So that's number one. Number two, it has to be the whole data set, because if you are missing one part of the trading book, your numbers is going to be incorrect. So if you are using multiple systems, you need to first collect all those data in the same place and then do the calculation. And that's for whole, 100% of the portfolio, not 98%, 100%. So many clients are, of course, thinking of it's a big data problem, so we are in the cloud world, so we're not using cloud. But cloud comes with other problems, as mentioned by some of our clients, like you need the local regulator to accept that the data will be on the cloud, which is not, maybe in EU, it's okay, but in many other countries, in LATAM, for example, it comes with serious challenges. So what we do as a vendor is, of course, make sure that they can leverage the cloud infrastructure to store this data, that the calculation will remain, the same, and that it will work all together. But practically speaking, it's not easy for banks.
And higher interest rates look set to persist. What challenges does this present for banks?
Well, I'm not going to come back on to comment on the intermediation aspect or the maturity transformation topic, because obviously high interest rates create a lot of pressure on banks' businesses for that. What we saw at ActiveViam is a huge impact on all the collateral topic. So typically the collateral optimization topic. So we used to have banks, posting cash to cover their position. And today it's not really the case anymore. So there's a real trade-off in between, or if you need to have some efficiencies around that. Otherwise, it could be very costly. So the collateral optimization topic is very trendy today for that reason. Same as liquidity actually, but also reason.
We're just coming on to that actually. And to what extent do banks need to reassess their liquidity stress testing assumptions in light of 2023's bank failures?
Yeah, so it's what we saw is first of all the speed. So it happened very suddenly, and then when you look at the impact on SVB, for example, it took like 3 days to collapse. So it's so fast. I mean, in one day they've lost $42 billion. So it is a huge impact. And taking into account this kind of scenarios when you assess your liquidity buffer, when you know how much you can resist in case of crisis, becomes almost like not a monthly or quarterly type of analysis. Just do that day after day. It's a daily task now, and every day there's a new scenario that is requested because of not only because of the interest rate or because of the inflation, but for all sorts of reasons that we see in the macroeconomy today. So there's a huge impact on banks' liquidity stress test today, and they need some flexibility to do that almost instantaneously. And it's a game changer in terms of analytical capabilities, being able to do that. Forget about the whole system that will take 3 days to run, to deliver you, the data after, rerunning, storing the data, and then analyzing the data. No. Need to do that now. I want to act on it, on my data, and see the impact on my regulatory ratio right now. I need to be able to communicate that to the organization and eventually to the regulator, who ask more and more questions like that.
And how can banks maximize value from their investment in liquidity risk management tools and technology?
Well, it's actually about connecting the dots. Like you have an analytical environment for your stress testing, for your liquidity stress test to assess the impact of a runoff on a category of depositor and stuff like that. But in reality, it's all connected. You want to be able to have a view of your inventory, at any point in time. You want to be able to forecast the impact of the trading activities on tomorrow's inventory. So you want to do what-if analysis on your inventory for tomorrow. You want to be able to collect or get the right asset to cover a position, but not the next day, today. So all of that means that for banks, the technology and all those different analytical topics, collateral, inventory management, liquidity risk, balance sheet management, are all linked. So in reality, this is the way they can leverage, this kind of technology. They can leverage technology in general in order to address the whole, problems, in one go, I would say, right? So that's what I would say the way they could leverage the investment.
David Cassonnet, thank you very much for your time.
Thank you very much. Thanks for having me.